Good afternoon, listeners. As you are aware, today we are going to talk about how to attract investors to your venture, to impart practical and working know-how of the process of raising successive rounds of capital, to share insights on how to select growth and expansion opportunities, to develop a funding roadmap for your venture or business. So here we are possibly talking to all of you listeners who are at the early stage of the game. You have crossed the stage of a prototype, you have trials, and now you are ready to go and launch your product in the market. You're looking to raise capital. So the first thing that any investor is going to ask you is, have you done something called a demand estimation? Good idea or a product, or so you believe. So what is the estimated demand for your product? Now, what is demand estimation? This is a process involving generating estimates of the demand for your product or service. So you would have to define this in terms of quantity of sales over a period of time, such as a month or a quarter or a year. So this is only one of the parameters used to predict the success of the future of your business. There are various methods used for this demand estimation, such as a consumer survey, market experiments, or statistical methods. So the next concept that we are discussing within demand estimation, the two components of quantifying the overall demand in terms of sales volume are price and quantity. So if you want to understand what your demand is going to be, you will have to first define how you're going to price your product or service. And here one of the important things is, if you do not have the pricing right, you are most likely to not get your assessment of demand correctly. Similarly is the case with quantity. You will have to be able to fairly estimate going forward what is going to be the demand for your product in terms of number of units that are going to be consumed. Now this is something which will give you some idea of what are the factors which affect demand. See, one of the problems that we face when we talk to entrepreneurs, and they seem to have a lot of good ideas, a lot of domain knowledge or expertise on a particular subject, and they usually go around focusing their energies, concentrating their resources in trying to build a product or a service which aligns with their competence. Now, while this is all very good because you are likely to be very good at what you are doing, it will eventually not be relevant in the marketplace unless it is going to cater to a certain demand which exists, or is going to cater to a potential or prospective demand which is likely to be there in the market. And therefore it's very important to understand typically what are the factors affecting demand. From the data here, we are looking at something like businesses related to IT, ITES, e-commerce, m-commerce, and so on. And therefore, we have to have a fair understanding of the landscape of what is the underlying data. So for example, if you look at the growth in computerization and from the past to the current and the likely growth in the future, from PCs to handhelds, laptops, and going on to mobile devices, this graph gives you a fair idea of where we are, how we have moved, and how we are likely to move. So if you look at the data on the right hand side, in India, the current mobile subscriber base is around 700 million, and smartphones as a percentage of those as handsets is only 9%. By 2015, use in the market is expected to increase to 270 million. Of which 270 million would be smartphones. By 2016, mobile services revenue is expected to cross US dollars 30 billion, which is about 1.7 lakh crore. And by 2017, smartphones as a percentage of handphones is expected to be almost 30%. Now this gives you a very clear direction as to what kind of products or services you could possibly try to develop, for which there is likely to be a market. To talk a little more about factors which affect demand, here let's look at some very, very broad global macroeconomic trends in terms of population, demography, and economic data. What are the overall larger trends which are playing out across the world now? Rapid technological advances, increasingly globalized knowledge economy, greater focus on sustainability. What are the trends in education? Around the world, institutions are exploring new ways of offering students well-rounded education. The definition of education is changing, and the new trends cover 21st century employability skills focusing on better well-being outcomes, personal resilience, adaptability, and developing community links. Also, given India's and China's share of the global population, by 2020 it is estimated that India, China, US and Indonesia will account for over 50% of the world's 18 to 22-year-old population. Between now and 2030, India will add 241 million in the working age population, compared to only 18 million from Brazil and 10 million from China. And globally, the largest number of students studying overseas will be from India. Now, when we talk about the supply side, so we've talked about the product or the service and the demand, and now we come to the supply side. Now, although this looks like a lot of information here, just ignore the first 4 columns, which is, the subject, the category column, and the first 3, which is traditional industries. When we talk about, and our focus for this session today is the 4th category, which is the SMTE, which we call modern small and medium enterprises, which are in manufacturing or services, and which typically comprises business like electronics, biotech, cosmetics and pharma, EOUs, auto ancillaries, computer hardware, software, media, animation, KPO, online, and so on. Any kind of services typically that we look at now as businesses which are going to scale and which are going to attract institutional venture capital funding all fall within these categories. All the other, the businesses, the trades that are included in the first 3 categories do exist and will continue to exist, but as you can see, these are all legacy industries or trades which are not eligible for funding by institutional investors, and therefore it's not a part of our discussion. Now, this is the most important concept to understand in terms of today's discussion. As you must be aware of all the cases that come up for funding before an investor, a typical venture capital fund, only between 1 to 5% actually get considered. That means for every 100, they fund only between 1 to 5 cases. And that's because they find 95 to 99% of the cases ineligible for funding. Now, sometimes the entrepreneurs find it very difficult to understand what is that is lacking in their plan, as a result of which their plan has got rejected for funding. They fail to understand what it is. And here we are trying to tell you that what it is the concept called pivoting, which you have probably not done, and that's why your plan is rejected. So what is pivoting? So a pivoting is changing direction, moving and adjusting till you get the right outcome. Now please, although this looks like a fairly a busy slide, let's move from the top left hand and down all the way through the route, and I'll explain to you as we go along. You have a problem to which you have identified a solution, and you have an idea. Out of that idea, you have developed either a technology, an application or a product. But you see, what happens is this technology, application or product, in order for it to get converted to an offering, it has to follow a straight line in that arrow, a specific offering. Many times between the idea and the offering, you have done a lot of work either on the technology, application or product, but you still don't have the right offering. And therefore you're going all over the place, which is indicated as the places where you're reaching following those dotted lines. If you see this arc, which has dots here, colored dots ranging from green, yellow, orange and red on both sides, it means that you will start reaching a point which is the green light, and you have to keep moving down till you reach that red spot. That is where you stop moving around or doing trials or trying to play around or trying to iterate. This is where you have got the offering. So at every stage, this process of making adjustments, iterations or changes to what you are doing is the process called pivoting. It is changing direction, making adjustments till you have the right result. So as you can see throughout what we are talking about when we talk about pivoting is prevalent or is necessary at each and every stage, right from your problem or idea where you reach the offering, to prototype, then to pilot, down to commercial trials, to where you have a product or a service which is ready to hit the market. And then from there on, once you have the product or service, also you'll have to examine various models of packaging, pricing, the model of the product itself, what is the look and feel of the product, and so on, and then on to the selling and distribution whether you'll sell directly or through channels, whether you are B2G or B2B or B2C. This is a fairly simple process, but most entrepreneurs make it very difficult for themselves by not paying heed to the need to do this. So they reach a stage sometimes where they have a good product, it's past commercial trials, but then they simply can't define very well whether they are B2B or B2C and whether they should be selling direct or through channels. So all you need to do is go out into the market and try and find what the others are doing. Find a competitor, find a comparative product, and find out what needs to be done, and keep trying till you have it right. If you try to start just sitting within your own room and doing thought experiments, you will not be able to make progress on it. What is the product market? What is the product market fit? Now this is for the benefit of all the listeners. Mr. Maruti had a specific query because he was at a stage where he felt that he needed to pivot. Now why do you need to pivot? The reason why you need to pivot is because you have to have the right product market fit. And what is product market fit? So you know product market fit has been reached when customers are buying the product as fast as you can make it. So you have something which is selling, or usage is growing just as fast as you can add more capacity. So you have a product which is already out there and you're augmenting features, creating new models or variations of the product, which is that it's, your cash register is ringing 24 hours. The other important aspects of the product market fit formula is that you have to bear in mind that picking a great market is better than having the right team or a killer product. So if you recall the discussion we had on demand estimation plays a very important role in determining the future success of your business, because if you've picked a great market, there are better chances that you'll be able to sell whatever product you have and make money. So VCs get excited by market potential. If the team is good, they're often prepared to invest on the hope that they will come up with a good product. So you may not have a good product this time. That's fine. You may not have the right product, but as you go along, you'll be able to perfect your product or improve on your product, which will help in increasing traction and demand. The second point to remember about product market fit is that startups need to pivot if their initial assumptions prove to be flawed. So please remember that a startup has made no sales in the first year. You started with an idea, you don't have any inquiries, or you have a trial product out there, no one is responding to it. It means you are doing something wrong. You need to consider whether it's targeting a poor market. If the product is wrong, or you're not understanding, simply not understanding customer needs. So just carrying on doing whatever you're doing without making any changes is foolish. Before product market fit, you should try and keep costs as low as possible. So once you have found your niche, spend money freely and scale with the best of them. While you are still searching for that sweet spot, keep your costs under control. Hire people who know how to iterate, not how to stick to the norm. So do not hire people who are living, who are going to be a drain on your resources. Have partners who are going to go out on a limb, like to find co-founders who are going to be able to take risks like entrepreneurs, go without salaries, and so on, and help you to achieve the product market fit. If you are raising seed or Series A capital, you are probably before product market fit. And if you are raising money now at later stage round, you are past product market fit. So typically, the stage of where you are is determined by whether you are pre or past product market fit in terms of the funding process. So this is again very related to what we discussed earlier about how to pivoting and product market fit. You have to understand all these forces that act on your business. What is the potential of new entrants coming in? What kind of bargaining power do your suppliers have? What kind of choices do the buyers have? How many other sellers are there in the market? And what are the substitutes, and therefore what is the threat of substitute product or service? Once you have broadly identified your market segment as to whether it's going to be the business or whether it's going to be the government or the consumer. The next important thing to do is called the segmentation, targeting, and positioning. So segmentation is simply the process of grouping people or organizations within a market to similar needs, characteristics, or behaviors. So dividing the market into groups. An entire market rarely has the same tastes and preferences. So for example, if you are going to be selling, let us say, products meant for teenagers, you will have to find a cluster. This is market segment. Children, population aged between 12 and 20. And you are not going to be looking at an elderly population. So that is your target segment. It is difficult to handle all preferences at the same time. So therefore you cannot be everything to everybody. Your product or service has to cater to certain specific needs and demands of a chosen segment only. Targeting is the actual selection of the segment. Once you have decided more or less what your product or service is going to be, you actually select that segment you want to serve in the target market. And it's a group of people or organizations who need a product that your product or service is specifically designed to satisfy. And positioning is the use of marketing to enable people to form a mental image of your product. So how do you enter their minds relative to the competition, relative to other substitute products, as a new entrant, as a supplier of a product, as a brand, or a supplier of a product or a service that is going to meet a specific need or demand of theirs. Very quickly, once you have a part of the positioning is the value proposition. Why will you succeed? You must identify what your value proposition is. So what is value proposition? It is a promise of value that you will deliver, and a belief from the customer that the value will be experienced. So 15 rupees for a bottle of Coke, you know what you are getting in, what you can expect. Okay. A value proposition can apply to an entire organization or parts thereof, or customer accounts or products or services. Creating a value proposition is a very important part of business strategy, and developing a value proposition is based on a review and analysis of the benefits, costs, and value that an organization delivers to its customers, prospective customers, and other constituents. It is also a positioning of value where value is equal to benefits minus cost. So your cost will also include the risk of offering that service. So in short, it simply means, why should the customer buy? They see something of use or utility to them for parting with that money to buy your product and not someone else's. Now we believe that we are at a stage where we have understood all these concepts, and therefore we have done enough pivoting and are now ready with a product or a service which we think is going to sell successfully. And now we want to go out and approach a venture capital investor to invest in our business. This section we try to understand the mind of that investor. What kind of ventures excite these investors? So this is a very snapshot of the various stages that every venture goes through. So if you can see the various stages, starting from affair and then to courtship, and then it's an infant to a go-go, adolescent, prime, stable, aristocracy, early bureaucracy, and death. Now as you, some of you are familiar, but like I said, apart from just getting funding, even in terms of lasting in the marketplace or being there, less than 5%, 5 to 10% go beyond the adolescent stage or reach the go-go stage. So 90% or more die between the affair and the go-go stage or the adolescent stage. Another 2 or 3% before they are prime, which is, as you can see, these branch outs from the infant and the stage between adolescent and prime are where they have declined or died out. Infant mortality or family or founder trap or unfulfilled entrepreneur premature aging or divorce. So what are the stages? Typically, therefore, if you relate to what we saw earlier, the stages at which any investor or business requires funding is ranging from the inception stage to the maturity, expansion and maturity stage. And the way there are various risk levels, various types of risks and risk levels associated with each of these stages. So this slide is self-explanatory. As you move from the inception stage to your growth stage, at the inception stage, all these different kinds of risks, which is the technology, market, execution and finance, are very high. The risk on technology starts lowering as you move out towards growth stage, so that it's low at the growth stage because your product has been accepted in the market, it is established, selling and sales are growing. So there is very little technology risk. And your execution risk is moderate because you've proved to yourself and to investors and the market and customers that you have been able to move along from offering, making a promise of a certain product or service, a prototype, trials and selling and reselling and growing the market. So selling back to the same customers again or selling the same product to new customers. Everywhere you've succeeded, and therefore your execution risk has been moderated or minimized. Finance risk is high across because at any stage financial failure is something which you can never predict unless you have the requisite expertise to handle the aspect of finance and business. So therefore finance risk continues to remain high until you've reached a maturity stage when more or less a business is running on self-financial risk. So what are the types of funding which are typically available to early stage businesses, and what are the preferred options? So if you look at this, at stages of business, at the early stage or the idea or the prototype stage, you need seed capital, which is typically sourced from founders, family and friends and angels. At the next stage, you have Series E followed by Series A, typically 1 to 5 crores, Series B, and then Series C. Typically Series C ranges between 5 to 200 crores, and then subsequently you have the IPO, the public markets, the secondary offerings. What we are focusing here today is the angel stage and Series A and B. So angel stage and Series A and B, typically the early stages, what do you need money for in the seed or startup stage? So typically you need money for market research and product development. In the early stage is for funding full-scale operations and selling products or services. It may or may not, it's usually not yet profitable. And at a later stage, the funding is required for expansion of new products. And the business is now near or post break-even, and that's when you reach a Series C. The typical investments are the early stage, you have venture capital investors. At the early stage, Series E or just prior to Series A, you have angel investors. In Series A, you have venture capital investors, early stage venture capital. And Series B and C, you have the mid stage, later stage private equity. Either they are called late stage venture capital investors or early stage private equity investors, whichever way you look at them. And in the mezzanines, the Series C is usually made by late stage or growth stage private equity investors. So just to give you an idea of what venture capital and private equity funds exist for, what is their purpose, and what role do they play in supporting ventures. So if you look at this slide, broadly we can divide them as between early stage and late stage VCs and PEs. Early stage investors have a particular emphasis on seed or startup businesses and entrepreneurial undertakings, whereas late stage players typically invest in transformational value added and their active investment strategy. What are the different kinds of stages, the stages at which the companies or business is moving, and what are the typical features? So at seed stage, you are at product development or market research. At startup, your key management is in place. You are probably doing your initial marketing and pre-sales. At the growth stage, product is in development or in the market already, and you are now ready for your first institutional financing. At the expansion stage, you are going to ship out products. Funds are needed for working capital or manufacturing facility expansion. And at the mature stage, you have stable growth rate, you are likely to be profitable and cash flow positive. So the industry, which is the VC players, PE industry, spans the spectrum from individuals, they are high net worth individuals who provide seed capital, to companies that are just starting out, small funds which start up as small VC PE funds, to larger funds which are operating for more than 40 or 50 years, specializing in multi-billion-dollar buyouts of large mature businesses. So what are the kinds of ventures that excite PE or VC investors? So as you can see here, venture capitalists are most excited by ventures which have a mix of a low technology risk, a moderate market risk, and they are able to go with a fair level of execution and finance risk. Whereas PE investors, for them, they look at companies which have very little, very low market technology and market risk and moderate execution risk. For them, the key to your being eligible is the execution of taking it to the next level of growth. Therefore, they would have to see a track record of some execution, of scaling up a business just from an idea, from either the existing business or the entrepreneurial team. There is a track record of having done that in the past. So let's look at a typical venture which was funded recently, a venture called Pepperfry, and the founder is Mr. Ambarish Murthy, who was the former country manager of eBay in India, and Ashish Shah, a colleague of his. What is the USP? They stock more than 8,000 products. This is an online retail platform. They stock more than 8,000 products and offer a 15-day return policy. They undertake bulk orders for corporate and gifting. The positioning is offering over 25,000 affordable lifestyle products online. It's at pre-revenue stage when it was funded. Employees is less than 75. They started in May 2011 and launched the site on 3rd January 2012. The business volume when they launched, see, this is typically how well prepared they were before launch. So the day they launched, by 7:30 p.m. the payment gateway crashed. They could complete 700 transactions, and the founders had to be on the phone to attend to over 100 customers after having completed these 700 customers till 6 a.m. for the next 10.5 hours. By then, there were 1,300 transactions within the first 21 hours of launch. So in the first 3 weeks of launch, they had 150,000 visitors and 1.5 million page views. So this is, they had done such they were so well prepared, they had understood the market so well, and they timed their launch so well that this is what happened when they launched, the day they launched. And the investors for this venture was Norwest Venture Partners, who invested $5 million in the Series A funding. And the rationale for them, so these are, I'm exactly quoting what Norwest Venture said about this investment, that we at NVP are excited by the e-commerce opportunity in India, and Pepperfry resembles a multi-product department store across apparel, bags and accessories, furniture and home decor, jewelry and perfumes and cosmetics. We'll just talk very quickly about the Google story. Started in 1998. The first funding was secured in the form of a $100,000 contribution from Mr. Andy Bechtolsheim, who was a co-founder of Sun Microsystems. So in 1998, there were very few. Andy was probably one of the few angel investors for technology ventures, because very few people understood something like a Google business at that time. But he made this investment, and in 99, Just 1 year later, they had another round of funding of $25 million with major investors, for the first time institutional investors coming in, like KPCB and Sequoia. 5 years later, they had an IPO with a debut listing of 1.7 billion, and they raised 1.7 billion, and they launched with a market cap of more than 23 billion. In 2005, they had an additional round of funding, but in 1 year, the market cap had multiplied by more than 3 times, gone to $80 billion. And Sequoia was an investor at this round again. They came back for their second round of investment after 6 years after their first round. By 2012, as we all know, Google, more than 30,000 employees and total market cap of 190 billion. The value of Mr. Bechtelsheim's $100,000 investment stood at $1.5 billion in November 2010, so which is an ROI of 227% over a 12-year horizon. So this is how a PE or a VC makes money from investing in a winning venture. What is this concept of investing, revenue, payback, and profitability? These bars that you see, which are the orange bars which are going down, is the phase when money is going in, and the black bars are where money is coming in from revenues. You're selling your product. As you move along, depends on the nature of your business, anything between 2 to 5 years is when you will start breaking even, which is the stage where payback, if you see, there is nothing, there's no bar there. That means all your investments now have totaled up to all the recovery that you've made through sales, and the final 3 are where you've reached a stage of profitability. So every business has to go through this cycle. You have to be very well aware of this, but very, very realistic in planning and budgeting the need of how much money you need to reach that stage of payback. Because most entrepreneurs have difficulty in computing this. So typically this is what you need the money for. If you are typically the cost of the project, which is assets and working capital, and the money, where how do you get it from? Like we discussed earlier, for the early stage, it is self, family, and friends. Then comes the stage of angel and venture capital. And as you mature, as you are in growth stage, as you have turned profits, you are also eligible for short-term and long-term debt from institutions. This is just how to draw up your financial statements. So typically all that money that if you looked at in the earlier one, the sources of funding are on your liability side, the utilization of money is on your asset side, and your profit and loss, the operating statement is once you have started selling products and getting profits from your enterprise. So that is the end of the presentation.